Hey traders, Jason here from Leavitt Brothers. Today is Fed Day, so I want to talk about rates. But I don't want to get in an argument about should they raise, should they lower, any of that. I'll leave that to other people. What I want to talk about is the overnight rate. I think in today's world of amateur journalists, words, terms get used interchangeably that aren't actually interchangeable. So I want to talk about what the overnight rate is, how it works, and why the Fed tinkers with it. Okay, first let's back up. The reserve requirement. Okay, all banks have what is called a reserve requirement. It is the amount of money that they are required to keep in the bank in cash or at a local regional bank. Okay, and the reason why they do this is because they want there to be a flow in the economy, people depositing money, people taking money out. They want, in case a lot of people withdraw money from the account, they want the banks to have a certain amount of money to act as like a buffer. Okay, they don't want to run on the banks. Okay, now big banks, small banks, they have different reserve requirements. Doesn't matter, out of the scope here. So if you have, say, $100,000 in the bank, they may be required to keep $10,000 in the bank. The other 90 they could loan out. Okay, and that $10,000 is just in case you go in and you want to withdraw money. That is the reserve requirement. Okay, so where does the overnight rate come in? If a bank does not meet their reserve requirements, they're required to go out and borrow money temporarily on a short-term basis every single day in order to meet their reserve requirement. Okay, so if you put 100 grand in the bank and they're required to have 10%, let's say they only have 9 grand in the bank, they're required to go out and borrow $1,000 in order to temporarily meet that reserve requirement. I don't know if it's at like midnight or 2 in the morning, but at some point in time, every 24 hours, they must meet the reserve requirement. The rate that the bank pays in order to borrow money overnight in order to meet the reserve requirement is the overnight rate. It's the Fed funds rate. It's the rate that you hear talked about every 6 weeks or so when they have an FOMC meeting. Okay, so when the overnight rate is low, okay, so when everyone's saying they need to lower the overnight rate, when it is low, banks are essentially encouraged to aggressively lend because the penalty for not meeting the reserve requirement is low. Okay, if the overnight rate is 2%, it's pretty cheap to go out there and just borrow money to temporarily meet the reserve requirement. But if the overnight rate was, say, 5 or 6%, then banks would pull back. Okay, so when the Fed raises or lowers the overnight rate, they're essentially tinkering with the bank's willingness to either loan aggressively or loan much less aggressively, because the penalty is either high or low. Okay, that's all the overnight rate is. That's all it is. Okay, banks have to meet a reserve requirement. If they don't, they have to borrow money at the overnight rate. And if the overnight rate is high or low, the penalty for meeting the reserve requirement is either high or low. So banks are either encouraged to loan, which means money is going out, flooding out in the economy, or they're discouraged to loan, which means the banks are going to hoard more money. And this is just one tool the Fed uses in order to tinker with the economy. If they want banks to loan and they want money to be flowing out there, they lower the overnight rate, which is essentially a way to lower the penalty for not meeting the reserve requirement. This is just one of the tools that the Fed uses. They have several others. This is just the most popular one, or at least it's the one that the media talks about the most. So today's Fed Day. That's what they're going to be talking about. They do it every 6 weeks or so, and I guess we'll see what they do. I'll see you next time.